All right, guys, welcome back. The Edge Zones Real-Time Support Resistance Part 2. I'm excited about these videos and about doing these videos because it's almost taken 20 years of experience and been able to put a visual on it that people could understand and see what's going on in real time that isn't really around. And if there are visuals around, people don't take the time to explain how the heck to use it. We talked about in the first video of these edge zones about real time being everybody's weakness. You do all this homework, all this preparation to put your lines on the screen, and then the game starts. Can you adjust like pro athletes adjust after the game starts? We used a football analogy in the previous session about edge zones. I'm going to use a baseball analogy. You do all the taping, all the video homework on the pitcher you're going to see. You're a hitter, and you're trying to figure out how he's going to pitch you. How is he going to pitch me? Low and outside. He's a curveball pitcher. You do all that analysis, all that homework, and then you get out there and you're not paying attention to any of the tells that he might be giving you. You're not paying attention to the count, to the real-time excitement and emotion that you're filled with when you're in the batter's box. So preparation is important, but real-time execution is what's missing, and these edge zones do a great deal to kind of solve that issue. So what we're going to talk about in today's session is going to be the whole series of things we didn't cover in the last one. So we talked about real-time support resistance. We talked about using them in multi-markets. We talked about in multi-time frames and filters. We talked about virgin versus non-virgin, B2B moments. We talked about air pockets or gap fills. Now we're going to talk about the rests. When they cut off in here, we're going to talk about the longer ones and where they come from, predicting the next consolidation range, double stack, triple stack, the additional value that they provide, and then how to filter it and kind of go from there. But I'm not going to do it with images. I'm going to do it with a chart that we're going to scroll back and forth with, and even in multiple markets, because not everybody taking this deep dive course is trading the S&P minis. There's a lot of NASDAQ traders, oil traders, gold traders, Forex traders, stock traders, and everything else. So price is price, trading is trading. And as long as you got the data on Market Delta CQG, you're going to have access to these edge zones. That's what's nice about them. But going back to what cuts them off, what makes them stop continuing all the way to the right? And if you look at this one, you could see this one was one that was short-lived. The market sold off a little bit, came back through it. It must have closed above it, and that's what cut a red one off. If this bar doesn't close above it, this red one continues to go across. And it would have penetrated a little bit, but it would have still been there. This is a 4-point figure, and we talked about it again and again and again when we talk about point and figures, that it's what? Rotation. How many times have we done that through the series? This is how your eyes get fixated on this particular chart, right? So when you see that, you're like, well, what made this red zone not continue on this yellow path? This bar must have closed above it. So for red ones, all right, if a bar closes above it, they will cease to continue to move to the price pane. Just the opposite for green ones, right? There's some green ones over here, but let's just wait a second. Let's just pretend there's a green one right in here, and a bar that you had was a 5-minute bar, all right, a 5-minute footprint bar. And the market was moving down, and it went through, this is a green one, it went through it, came back up, and then closed. The bar would have closed there. This green one would have stayed intact. It would have continued to move over to the right, because the thought process is, yeah, it breached it a little bit, but not enough where it would take it out and it's still relevant. However, if we remove this illustration a second and draw in, you know what? Let's do this right. Let's draw in a real green line, and the market's coming down to it, and the 5-minute bar closes here. What happens? Then this green would go away, would cease to continue. It would stop right there, just like this red one does, only it would be green for support. You could change the colors of this if you don't like red and green. I use green for support and red for resistance. Some people use blue for support, and that's fine. That's all. Everyone has the ability to change that once you get into the software. So for a second here, let's go and look at a green one that gets cut off right here. Very next one. And you could see that the market has to close below it, and it must have down in here, cutting this green one. So again, rule of thumb, a close above a red one, the red cuts off. A close below the green cuts off. Because that means it didn't, hold it. And generally, the closer to when you see an edge zone come in, the less likely it might hold because it just kind of happened. So you want to be privy to that. But you got to know what makes them stop continuing across to the price pane. And that's what's important. The next one we talked about on that list, and that list of the checklist, predicting the next ranges. How many times, most people aren't even good at being able to see a consolidation or a fight after it happened. After it happened, they're not even good at saying, hey, this was the consolidation fight and let's find the winner. They could draw a box around it and see the market chop sideways. They're not even good at that, let alone trying to predict where the chop might come from before it comes. And so you could start to sharpen your predictive skills. So if you look at this bar, if you look at this red bar and green bar, at this particular point, this is what we mean about the hard right edge. How do we trade when we have to trade? And that is real time. I always say to people, no matter if you're a short, medium, or long time frame trader, you have to get in and out real time. So right now, I'm going to assume that the high and low of this fight is going to be this 97 quarter and this 95 even. Why? Because I've got some edge zones that are apparent down here at the bottom and up here. So as we go over one bar at a time, sure enough, it's not random that they did work as support resistance. I'm not pulling this stuff out because it works. I'm pulling it out because you see it time and time and time again, where it gives you good consolidation, assumptions. Accurate assumption is where the hell the consolidations are going to happen. So indeed, you could draw your box around there before it filled out instead of always after it fills out. And now I'm looking for a winner. The bulls win above, above this top line. The bears win below. And you could see why the market is now respecting these areas. Tempo matters, like we talked about on the previous video, as to where these come from. When the market moves up faster, where did it move up fast? Let's say it was inside that yellow box. Then a green bar would come across. If it moves down fast, a red bar would come in. We know that. We understand how the imbalances create speed and how speed now creates these edge zones. So instead of just having to see them as an imbalance, we could set the criteria to throw in a line to help with the what's weak, what's the weakest part of our trading, and that's trading. That's the real-time analysis. All right. So let's go back to the checklist. Long bars across. Where do they come from and why? Well, they just never were breached and taken out. We started with what makes a bar get cut off and cease to exist. A close above it, right? A red bar, close above it, it'll stop at that bar, like this one here, okay? Closed above it, it stopped. Well, what if it never gets taken out? Then it's going to continue for a long time. Again, this is the S&P E-minis. Let's just come across and say, hey, look at this one. This one came from way, way, way back. And you want to get a sense of these levels, and this is when you do your homework, because not all of these are coming in real time. There's the value of when these guys came in the past, and you go back and you say, hey, this one's never been touched. It's a way to start to separate the virgin from non-virgin levels that got taken out and those that have never been touched. Then you also see this quadruple stacking of these. I like the longer ones because they're more symbolic of something that's never been taken out. And it's not going to be a coincidence when they get, I got to even go further back on this. Excuse me. I dropped my ring here. I got to go further back. Wow, look at this. So it worked as consolidation in here, and they haven't taken them out this 90, 97, 90 even to like 91 even area ever since, 4 or 5 days ago at this point. So while it has worked, it's been away from it a while. It's going to be used as near-term support until it's taken out. There'll be more rotations on it before they take it out. So then you come back to real time, as we'll move a little faster here, and you could see the market when it comes in to touch it, that this thing has worked as some decent consolidation. They're probably not going to blast right through it. It's going to work for a couple rotations, and then there's a chance they take it out. This understanding you have, and it stays on your chart instead of having to draw your lines manually, or remember that the lines are already there. You don't want to have to do that. Now, not only are they there for you automatically, but you know why they're there. And that's important to really understand. These have been in there for a while. How are they going to maybe work for us? Let's go to our next checklist. Double stack and triple stack and quadruple stack and all the rest. What does that mean? What does that tell us? What it tells us is maybe a little bit more significance of the buying or selling pressure that's coming in. Let's take a look. These are green edge zones on the S&P. They're quadruple, 1, 2, 3, 4 that have come in. Now, remember we talked about the long bars. What it helps you do is think, where'd they come in from? Did they work in the past? And that's the way you start to do not only your homework more efficiently, but your real-time homework more efficiently. 4 stack could happen 2 different ways. A double stack is simple. That's just 2 quick edge zones that might have came in simultaneously. Price. Just remember this. Each one of these lines is just one price in any product you're looking in. So this block here is one line or one price 94 even, 94 quarter, half. Well, at some point we've got 4 of them that haven't been breached. So if we take this back, go a little faster. If we take this back, you could see how well it worked in a rotation. Let me get rid of that vertical line. How well it worked in a rotational sense all in here. The market came down and eventually rallied out. Actually came down again and rallied out. This is no coincidence. But let's continue to say where the heck these zones came in and go over a couple different ways on how they appear. Here we go. This is where this buying continued to come in. This is the first time I ever had to do this because I was excited and really projecting. I had to stop the video instead of doing a whole 45 minutes or a whole hour. I stopped it a few minutes ago and restarted because my throat was hurting. It's just trying to get across the level of how people now could start really stripping out randomness and how exciting to hear people doing that with this. Let's look at this, though. They became quadruple edge zones on top of each other because of a continued effort in a particular area of quick buying. One of them being in this yellow circle. The other one, and you could see, let's get rid of that a second. You could see where it starts, and it started because of that 1135 imbalance. Wham, it ran across. The other one started right here, 1250. Wham, ran across. The other one, let's get rid of those illustrations and go back. Go back a couple bars. This one started right here, ran across. This one came in on this big up bar. It took out all this resistance finally, and then used it as just great bottom of the range support. We talked about how it predicts a range. If you look in here before you know any of this, you know that there's some reds up in here going across, and there's a green down in here, and there's greens that then come in here. So before you know what's going to happen in here, you get a sense that it's not random. The fact that it's probably going to bang in between these reds and greens. You could see the selling pressure and the buying pressure duking it out, as I like to say. Because every consolidation, that's what makes a consolidation a consolidation. People are trying to get it to move. Bulls trying to get it to go up. Shorts and bears trying to get it to go down. Who wins and when? So you could see how these particular edge zones became subsequent support. Let's go back real time. You could see the market left. What did the market do in here? What did it do? It said bulls win. We talked briefly, I think, about this in the first session. And ongoing, we talk about this in real time in the trading room. People coming out of this FootPrint deep dive, do the trading room for a month. See this in real time happen with my analysis over it. Trading room is just a cup of coffee a day. You don't have to be in there any more than a month. You might want to stay because it's great analysis and it kind of gives you a sense you're not lonely. But to see this happen all the time, so it's not just images that that we pull up or these charts. But just look at this. I got to bring this to your attention. We know at this point, even before any of this, that the market had a big fight all back in here. We've seen the resistance finally get taken out right in here. Is it a coincidence that where the bulls won became support? I mean, look at this. The market rotates down, rotates down, rotates down, down. This 96 half area became resistance without any kind of coincidence, but with less randomness. All right? And if we take this and we look at it on the upside, you could see how the buying continued to come in this zone and created continued support until what happened? Until the bulls won again. And where does the market come back down and create more support? Where the bulls won again. You could look at this and say, when I see a red zone taken out, it's even better. It's even more important. It gives me a sense that when the market's up in here, I cannot be bearish. You don't have to be bullish, but you cannot be bearish. You just seen a nice zone get taken out. Didn't take long. You've seen the consolidation that had happened previous. Bulls win. And then if you look across, you could see it continuing to hold. When I prepared to do this session, I didn't look at these charts and say, this is what I want to show, and that's what I want to show. I'm just going through this. You could do this as part of your review you don't know what's going to happen. And you could just start to see and predict without it being random. And that's a really good exercise to be able to do in practice to get better at the right edge. Here, I give you another bonus in this video. After I see this is as much information as I know. But I could tell you that the market has a high probability of using this as near-term support, and it happens. Now, obviously, I've seen that, but that would have still been my call having not seen that. And when you are able to do that, and then you're able to go through it one tick at a time or one bar at a time, and you see it work, does that seem random to you? But is it on the right or left-hand side of the chart? The right. The right. So the double or triple or quadruple stacks don't always come in because they're on top of each other. There could be, and we're working on the filter to just show double and quadruple stacks or triple stacks. However, it's not going to be able to pick up when they come across and they become double stacks. Let me tell you. So this would be a triple stack of a lot of buying, but they didn't all come in 3 consecutive price areas at the same time. What do I mean by that? Well, this one came in because of that guy. This one came in back because of that guy. And this one came in. Let me pull it back a second. Because of this guy right in here. And it superseded this guy, so the green took back over. The point I'm trying to make is, let's get rid of that. They all came in, consecutive prices. However, not in one bar. There's a difference. So if they happen in one bar, we're working on a way to filter so we only see the times that it happens in one bar. Oops, let me get rid of that. Here's where they happen in one bar and would create a double stack, red or green. And again, I'm just going back to find those particular levels. Like in here, this isn't a double stack, but they did happen in the same bar, so in the same sequence, and they got dragged across. This isn't a perfect double stack because they're not on top of each other. Is it a coincidence that the market held this teacupped as a bottom? Of course not. Here, another example of the green coming in, using its support until it's not. Let's just find this double stack, though, while we're going through it. Oh, look at this. All three of these reds holds the top of the consolidation. This one was formed in here. This one was formed in here. It'd have to be a pretty big down bar. So we didn't see it in that red. They're important because they all come in and you can continue to find where the bears come in to defend at different times in the sequence. When I say in the sequence, you know, this is all kind of one sequence, a couple rotations. And then you take it back. This is another sequence where they come in, selling is here. It's no coincidence that the support is where these other greens came in, down in here. And that's how the market comes down. Now you could say, well, what about these greens? It didn't hold it. Well, first of all, it did. All right. These are pretty close to when they just came out. They did hold it for a rotation or two. But secondly, obviously not every green is going to hold perfectly, but it is giving you a real-time sense of what should have happened, where the buyers are coming in, and where's the next target. Oh, shoot, I keep drawing that in there. I want to show, let's go back to the beginning here. I want to show you guys, oh, here's a double stack. Doesn't draw it across, but you see this imbalance. Didn't qualify enough to throw in a green bar, but this one did. And then on a different price level, that one did. So is that important? Absolutely. And then it comes back down and holds it as near-term support, at least for a while. So you're not, at the beginning of a session, you're not going to be able to say, hey, there's going to be some support that comes in here towards the end of the day at 97.5, 97 even. But then once it happens, you see it, and you can make a call based on something that happened that obviously didn't happen prior to the damn session starting. And that's what you have to focus on. Let's go to a NASDAQ chart. Some of you guys trade the NASDAQ, and it's a great market. It's $10 a tick, but it moves. It's $5 a tick, rather, but it moves. You know, it's really become a flyer. Trading almost 6,000 on the future side. It's been above 6,000. The NASDAQ before the bubble went from 1,000 to 5,000, back to 1,000 when the bubble busted in the late 90s, early 2000s when I started my trading career. But it's a mover again. I mean, it's really going, and you could see a double stack in here. What we would call a legitimate double stack because it's in the same bar. So here's the bar, okay? And you could see it's an up bar, and we should know that. And you could see it came at consecutive price levels and there and got sent across. This would be a quadruple stack if these down in here would have qualified. I'm talking about these four. But what I want people to do is to constantly review these levels and filter them, play with them based on the market you're trading, based where you're not having too many or too few. That's a very important rule of thumb. If you have too many of them, too noisy. If there's too few, they're not going to help you either. So you always want to be able to kind of find that sweet spot. Also, I mean, when you do your homework, pretend like you're trading the right edge. What do I mean by that? You're not going to be able to see me do this, but I'm going to close my eyes and I'm just going to go back. I hit control and the left arrow and just takes me far back as it does. All right. Now, I don't know what's going on in here, and then I stop. Now I got to find where price is. All right. And I imagine it's above because that's where these greens are. Now, this is all I know. I focus on the right-hand side. These two reds, I would imagine, are going to be resistance. This probably will not be support anymore. Why? Because it's already worked a few times in here. It worked a couple times in here. So now I'm going to go one bar at a time, and I'm going to see that top red be resistance. Was it? Yes. Did it work? Yes. Do I feel like proud I was right or made a good guess? No, because it's not a guess anymore. It becomes probabilities. Does this green hold? Yes. Do we come? Oh, we start to see the green get taken out. Is that something that I knew happened? No. It got taken out because it's already worked a few times. Did it become old support, new resistance? Absolutely. Did it walk back down to the next green? Yes. Where did it come back to? To the red. Then it takes the green out. I got to bring this back up. Steps down to the next green. Uses that as support. Walks up. It's probably going to use that 56 as support up here and this 50 as resistance, although I wouldn't be buying it anymore at 50 because it's already worked a few times in here. That's why I wouldn't be buying it. It's already worked. Flew through 50 to 53 be overhead resistance. Comes down, uses this green at 47 as support. Again, these levels, some of them are already in there from the past, a prior session, a prior move, but a lot of these are coming in to give you some real-time information. They finally bottom out, and for the first time in this whole sequence, if you think about this, and this is something I see that I'm sharing with you, but the first time in this sequence where we started going down, did they start taking reds out? They took a little red out here, but they couldn't take out a lot of these reds in here, follow my cursor, until here. They take out this red, they take out this red, and they take out this red. That means, yes, this is overhead resistance, but they're in trouble. Again, this is just my assessment based on what I'm seeing, okay? So they hold it, they come back down, they still hold this green, they blast through this one, this one, this one. Does it surprise you that it gets really fast in here? Of course not. Not knowing what you know now. What you know now is that it just didn't rally in here, but it rallied and broke some levels that typically hold. So the upside becomes the right side for a while. Where does it go? Next red zone. Where does it come back down to? As soon as it breaks this green, now I start suspecting that the bulls are in trouble. This is the way markets move, especially volatile markets like the NASDAQ. If the NASDAQ is going bullish to bearish too fast for you, then you're trading a market that's moving too fast for you. Markets go from long to short, short to long. It doesn't mean you have to as a trader, but you have to go with the flow. They're changing their mind all the time. As a trader, you have to understand what the market's opinion is. In fact, I want my traders not to worry about what your opinion is. I want you to worry about what the market's opinion is. It allows you to detach yourself from that personal sense of your opinion getting stepped on, and people don't like that. Nobody likes to be wrong. It's the market, and the market's wrong sometimes. It's too cheap, it's too expensive, and it's got to settle out. There's an old saying, the market's never wrong. It's never wrong if you're if you're comparing it to you and your P&L, were you wrong for buying it at 10 and then the market broke to 2? Was the market wrong or were you wrong? No, you were wrong. So in that case, the market's never wrong. But of course the market's wrong a lot, or it wouldn't move. It's too expensive, and then it goes down. It's too cheap, it goes up. So in this case, as soon as we get through here, you could expect some more downside. You get some red, and you could expect as I pull this over that this red holds because how fast it came down, how many they threw out. And it does, and it's just no surprise, I guess. And this market remains bullish until you take out some reds. Bearish down here until you take out some reds. Then you could start taking out this red, and you could start seeing the upside's the right side. Now, we could do this all day long, and it would be fun, but it becomes a lot more fun when you do it yourself, and you start walking through the market, so you become someone that could host a trading room. People say a good trading room moderator is someone that could help people understand why he's thinking the way he is, and that could be wrong quick. It's not about how often you're right. It's about how long you're wrong for. Here's a double stack red that come in. Is it going to hold this? Yeah, at least for a short time frame, and then it's probably going to come down in here as support. So let's get rid of those. There, it does hold for a couple rotations, and then what does it do? Come down in here and holds for the bottom as support for this. And then it gets choppy. What time is this in this session? This ends up being the overnight session. This is into the close. And it usually gets a little choppy at that time. That's the NASDAQ, right? That's why in this second session, I wanted to go through some charts as if they're, quote, live, in a way to be able to say, hey, where and how could these help you? How could they strip out randomness? The double stack, the triple stack, and so on. Now we put a check mark here. We covered how to filter already in the previous session, even though there's not a check mark here. We covered how to go ahead and do that. I want to look at another market or two, though, to help people understand, how do I know these edge zones have too many or too few? They should have a real high probability of working, or you've got too many of them and it becomes too noisy, all right? I want people to focus on when they don't work. When they don't work, it's just as valuable as when they do. You're going to come in. This is a session that when it reopens, you're going to find, in my opinion, in crude oil, I didn't draw that real well. Crude oil is going to have some really good support in this 46 to 52 area. Why? Because it threw out these green zones here, and it finally blasted through in this area up there. It went through this guy and everything else. That's why it used it as support initially. What did it use as support? Once it got through this red in there, came down, rallied, came down, rallied. Then they closed. Remember, this is crude oil, and crude oil trades in every penny. $10 a tick. Every tick is a penny. So for an area or a level to be 1 penny wide, it's pretty remarkable for a market like crude. So take a look at this level and how well these reds work until they don't. They get thrown in here. They get added to here. You see the defense, and then they continue to work as overhead resistance time and time and time again. This crude oil. Time and time and time and time again until they don't. And if you thought that they should work forever, you're not a trader. The fact that they worked this many times was pretty amazing. But it's no longer an invisible spot. Well, why it would get stalled out and be the top of consolidation there. If you take this chart again, going over. Look at this green. This green came in. Look how well this green worked as support in there, support in there, support in there, and then it got taken out. So what the hell you think happens? It works as great overhead resistance until that doesn't. Look at that. Now we go over. These two reds work as overhead resistance, and they came in at the tops in here, showing you the difference between a top that might be resistance and one that doesn't. These reds work really well all in here until they don't in there. And I'm just walking back with you. This is the first time I'm looking at this. I didn't know what happened on this particular session. I don't really trade crude oil a lot, but a market is a market. You could see that this red started this sell-off in here. So, of course, it's going to be, and remember, this is only a penny wide. So this price is 63, and this price where it came in is 58, just 5 cents away. But it's no coincidence. Where does it come up and stop? Put some red in, almost to the tick, a bunch of times. And that started, essentially, all this selling. This red had worked in here and all through here. I mean, we can go over and over and over this. When they don't work, they become near-term resistance. Like, we go through this again and say, old support, new resistance. And just sticking with the rotations of this market, they come up, and they fall off. The another thing that we'll try to do is create the ability to take old support, and when it doesn't work and it closes off, to create a different kind of line to actually show us that dynamic as well. It's a very powerful dynamic. And why? Because it's opposite of what most people are always going to look for. That's what you want to do in trading. You don't want to be in front of every herd, because when you get run over, they trample you. But you don't want to be with the herd, because they fall off the cliff all the time and they're dead. You've got to think against conventional wisdom. It might not work if you're a marketer. if you're a salesperson, if you're an advertiser, a plumber, electrician, but it does as a trader. You got to let the other people, you got to find out where the other people are wrong, stuck, nervous, and use that as subsequent support resistance. And that's what these edge zones are pretty much built upon. That's why no matter how many people find out about them and use them, they're not going to pop up on the screen unless there's that dynamic and emotion that's present. And so we can go through this until we're all old and gray here. The filter. I think we spoke a little bit about the filter in the first edge zone, but I want to bring, when you get a filter of bigger orders that come in, all right, which is in this case 189 or greater, when you get that, I want to see where they line up with a zone in the unfiltered chart, all right? So you could see that these zones, they do work really well, even though they got through, like we talked about with filtered areas, they got through here, but they came back up to there. They held this one, but then they didn't hold it. Then they held it in a rotation down to here. Can get kind of noisy, but there's a lot of really good stuff that comes from them when you could overlap them with what happens on top. On top of this layout, this is, by the way, the layout pretty much that you'll see in the trading room when you guys subscribe to it, but this is an unfiltered S&P chart. This is a filtered S&P chart. I also will share, people who join the trading room, my templates for these edge zones. I don't share them with people unless they're edge members or trading room members, so you don't have to go building a bunch of these. They'll all be set. You'll be able to import them. That, again, you'd have to be a Market Delta desktop subscriber and a trading room subscriber. So if you were to want these without having to build them, you could do that if you did those two things. But if you look at this particular price down here, this 97 even, 97 quarter, it's a green zone for the unfiltered, and it's a green zone for the filter. Or wait, maybe it's not. 97 quarter half. It's not. It's 96. It's this guy down in here. 96 has a filter for, or a green edge zone for the filter and one for the unfiltered. This gets into the close, which gets pretty noisy. But that's going to be good support is where I'm going with, where I'm going with that. 95 even. Great support. You had one in the area, 95 even, with this big buyer that came in and kicked it up. So you want to match the bigger orders, the filtered orders, with the unfiltered orders to, again, qualify what you're looking to do. In the end of this whole entire FootPrint deep dive course, it's all about taking the FootPrint and using it as a way to read order flow, to qualify and disqualify trades, and so you're reading the market in real time better than ever before. And if you're not stripping out randomness, understanding never, ever happens. So I want people to do the exercises of, what's going to make you better at reading the hard right edge. And that's not my phrase, the hard right edge. Other people have said it. What's going to make you better at reading the right side, the real time? The exercise of doing it. And walking back several sessions ago and trying to predict what's going to happen and document it so you gain the confidence and you become a machine behind your mouse. Where you're diligently then reacting to decisions instead of having to overthink every single one. And now you're updating your levels in real time instead of just depending on the information you had before the game started. Sure, you should do some research before the game start. Professional teams do all the time. But what wins and loses them games is what is made between the lines after the bell sounds, after the gun goes off. What adjustments did they make? Are you making any adjustments? Because when you don't make an adjustment, you break. You got to bend. That's how you survive. You got to qualify and you got to disqualify. FootPrint helps you do that as long as you learn the footprint. And that's what's great about this deep dive, is that it's finally something that just talks about the footprint essentially and what good comes from it, because there's so many people using it different ways. And hopefully from top to bottom of this program, you know much more about it than you did prior. One last thing I want to add before we finish up with this video is, do you remember in the last video in the edge zone we had, where the heck is it? We had this video, or I mean this slide with the houses, tying in the edge zones with Delta Profile. You should have a little understanding about Delta Profile. We added that early on in this program, even though it's a footprint deep dive. The Delta has obviously something to do with the footprint, and so we added it. But in this particular slide, we talked about how prices, there was popularity in prices at the 250,000 marker down here, and then up at 300,000. So if you were to see the tempo also pick up between 250 and 2 or 300, with this kind of price action, that would show you a thin spot and maybe an edge zone. That would be green. And this would show you potentially open longs that would look like this on a Delta Profile. See the green at the bottom? Right here. Maybe some open longs and a green Delta Profile there at the top. So what does this mean for us? Maybe a guy should have been buying it and his wife is upset at him. Next time it gets down there, you better not miss another house that we buy that comes in at that price. Maybe the price is coming down. Now, houses move just like the S&P or oil or the NASDAQ, just a lot slower, but the same dynamics involved. And this guy says, you know what, I ain't missing it, and I'll buy it, and he'll buy it. And he creates potential support for the price to go up. What created the dynamic of making price go from up here to down in here is indeed, if indeed there was a lot of open longs. So let me bring in a chart which shows a combination of things. This last sliver, look on the right-hand side. This is showing me X amount of days back and a combination of the same price buying versus selling. I think it's 30 days back. A lot of people that take this course also are volume or market profile experts or proficient in market or volume profile. Delta Profile is something you should become more proficient in than just straight volume profile or straight market profile. It's just telling you the volume that has an imbalance at it. The edge zones are showing you thin spots with an imbalance and tempo, and the Delta Profile isn't showing you an imbalance at price. That the longer the green that sticks out right in here, more of an imbalance at that particular price. So when you're coming into a session and you're doing your homework, you have all these edge zones in here, 1, 2, 3, 4, and the biggest green Delta Profile in that particular session, which is 30 sessions combined. Do you think that that's going to be an important zone? Do you see why it's going to create some support? Do you also see why, as you see price comes in and rotates back out, do you also see why it would be an advantage over others? Hey, you can learn volume profile all you want, but there's a lot of people learning in no volume profile. What makes it so unique? When you combine these two things, it does create a little uniqueness. You see it come in and you see it come out and you see it work. I'm just picking it because it worked. I'm picking it because the combination makes sense. Delta Profile along with edge zones to qualify and disqualify certain levels that you're away from. And you could take this and you could come up and down and say, this was going to be an important zone. This is different. This is from the previous days. And you could come up here and say, this was going to be a zone that's going to work as overhead resistance, either now or in the near future. And I don't know if it worked. All I know is that there's some red selling that came in last time it was up, and there's some stuck longs potentially that'll also be there trying to sell it. As we rotate back, you could see that this red came in above this green, and then these reds come in, and the market did indeed use it as overhead resistance. What does that mean? That means that it's not going to be very easy to get back through this area in just one shot. And one thing to remember when they try to test those highs in the future. I just wanted to tie that in with the Delta profile. There's more work that we're doing with this. We're in that direction of always collaborating to build on everything. Nothing is static. Nothing just remains the same. If you're not moving, you're moving backwards, is the old saying. So in trading and in professional trading, you're always working on the right stuff that makes sense and works. You'll see a lot more of this in the trading room, in the edge course, different things like that. I wanted to tie it in and give people a sense of how to tie those two things in together. First, you got to understand them, and then you move on to creating the ability to strip randomness out and keep trading that right side. Keep trading that right side. Keep working on your weakness, because the weakness of everyone is real time. Always remember that. Also, loneliness. Most people are lonely with their trading. And so if you don't get anything out of this program, which I think everybody does and did, just remember it's hard to trade alone, especially if you're not trading well. Many people are on an island and they seek out the wrong communities. Trading room in and of itself isn't a community, but you want to be able to talk to other people who are not lazy. There's a lot of lazy traders out there. You don't want to be associated with them. You want to be with people willing to work hard and understand what they have and what they got, and create those relationships. So thanks for going through this program. Hopefully you enjoyed it. You have our information to email with questions and everything else. It's one great thing about Market Delta and this whole Edge community is that we're available.